Good day, my name is Howard Kaye, president of the Howard Kaye Insurance Agency, LLC. A brief history on our company. It was started back in 1962 by my father, Barry Kaye, who really revolutionized the insurance industry. Now, this is not going to be your typical, traditional type of dry video on life insurance. We are going to share with you today what life insurance really is, how it's an asset, a commodity, a further diversification of your financial portfolio. You see, when we talk about life insurance, we think of money. And it's not a question of protection. Sure, when you buy life insurance, when you were starting out in business, when you were starting out with a family, you were taught that you had to have life insurance. God forbid the breadwinner passed, and you would want to make sure your spouse was taken care of as well as your children. But we've now come to an age and stage in life where life insurance is no longer needed for necessarily that same idea of protection. It's no longer a need, it now becomes a want. And why do I say that? Because we are focusing on people who have the wherewithal of creating a tremendous legacy, those that are trying to leave more to their family, those that are trying to create more during their lifetime, those that are trying to minimize the ultimate tax effects that will take place during your lifetime and upon death, showing people how to optimize their retirement programs 10 to 20 times what its current value is, showing people how to utilize life insurance in a way that will absolutely predict an inheritance, something that we call the 401k plan. Ladies and gentlemen, there is so much when it comes to life insurance and what can be done with it. Our purpose is to educate you and to share with you these ideas that my father and I have created over the past, well, now it's almost 60 years since my father started the organization. When I say he revolutionized the life insurance industry, we always did things that were out of the box. And, I was always taught that you think outside the box because you're going to get the best results. It's easy to be normal, but it's easier to be extraordinary. Why? Because I was taught to be extraordinary is just to do the ordinary things that ordinary people don't do. And that's the whole premise behind how we look at what this tremendous product called life insurance is. So let me take you back some years. When we think in terms of life insurance, as I mentioned earlier, we talked about need and protection. But as I said, we're going to transition into life insurance being just a phenomenal asset class. It is money. Now, before we even get started, how can I prove to you it's an asset class? Well, in alternative spaces of investing, one of the largest spaces is called the life settlement industry. This is where major hedge funds throughout the world are purchasing existing life insurance policies in the secondary market. You see, they look for an arbitrage. What does that mean? You bought your policy at a certain point in time when your health was good, let's assume. And as you've gotten older, as with most of us, health declines, especially when we get into our 70s and 80s. We also come to find that maybe the reason that we bought life insurance is different or was different then when it was purchased compared to what our needs or wants are today. So for those people who have no interest in continuing their life insurance policy, there was only one exit strategy, and that was to surrender that life insurance policy. But you see, with the advent of the life settlement industry, you have major funds that are purchasing these policies based on the fact that you're older. We know we're closer to death. We know our health is not the same as it once was. So these are all the arbitrages that are involved. And in many, often cases, you will find that the consumer ends up selling their policy for a lot more money than they could have cashed it out. We'll be getting into many more ideas utilizing the life settlement industry later, but I was just bringing this up to share with you why life insurance truly is an asset class, a further diversification of a financial portfolio. Now, moving forward, as I said, my father had really changed what life insurance was. Why? You see, life insurance used to be focused on building high cash values and showing people that you could borrow against these policies. Well, we came in with a different angle. Our angle was, you know how to invest. You're with an investment advisor. Continue with your investment. You don't need the life insurance from that perspective. What we want to do is create the most amount of death benefit for the least amount of money. A novel idea, you say, right? But think about it. Why would I want to overspend? Which many of you would say, well, then don't I just buy term insurance? Because let's talk about the different types of insurance. There's term insurance, there's universal life insurance, there's whole life insurance, there's indexed insurance, and there's variable life insurance. Well, what is term insurance? Term insurance is a certain amount of life insurance that you buy for a predetermined amount of time, whether it be a 10-year term, a 15-year term, 20-year, 30-year. At some ages, you can even buy a 40-year term. Well, you say, well, why would I buy anything other than that if that's the least expensive way to go? Well, the truth is because as you get older, you don't have those same options. So a 55-year-old can buy up to a 20 or 25, maybe a 30-year term, depending upon the company. But you see, when you're 65, you can't buy a 30-year term. You can still buy a 20-year term. So as you age, you're limited to what can be purchased. So that's what brings us into the next type of policy, a permanent policy, whether it's universal life, whole life, and we'll get into all the differences later. For now, the idea is that you understand that a permanent policy means that we can structure this insurance to last as long as you're supposed to last, which could be forever if you're lucky enough. We all know that's not true, but the insurance companies have structured these policies to go through your age of 125, so people should be comfortable with that. As I said, we'll go into further explanation of the different types of policies, why they're used at a later point, but let's continue down the path where my father and I, how we really changed the focus on life insurance. You see, back in 1981, there was something that was given to all of us called the unlimited marital deduction. And what that meant was that you could leave all of your money to your spouse, and your spouse could leave all of their money to you without any estate taxation. So what that meant was, if you were not going to leave any monies to your children until both of you passed away, then you didn't have to worry about estate taxes until the time that the second person passed. And this was really the advent of something we call survivorship life insurance, last to die life insurance. In fact, my father created this product in the 60s out in Los Angeles, California, when he went to a group of attorneys who said, you know, we have 5 partners. If one partner dies, we're okay, but if 2 die, we have a problem. He created a policy for that law firm. It was the only one, I believe, that was ever sold, and nothing until after 1981 when the government gave us this unlimited marital deduction. Now, why is it so important to talk about this last to die policy? Because this was the product that I could buy insurance on you and your spouse. No death benefit is paid out until both of you pass, but because it's on 2 people, it's the lowest priced policy that you can buy. Because if one of you die, the insurance company doesn't pay out. Both people must die. But you see, if you're not leaving your money to your children until you both pass, then there's no estate tax until that time, which is why we buy this policy, for the money to come in to help accommodate the estate taxes. We'll be talking about more on estate tax planning, retirement planning, and many other concepts and strategies along this guise of life insurance. But further down the timeline, once we showed people how to utilize these survivorship or last to die life insurance policies for purposes of estate planning, we also then transitioned into showing people how you are able to buy a certain amount of money on a predictable basis. What does that mean? Well, if you grasp the idea that life insurance is just money, then how much money would you like to buy? You said, see, you've never thought about it in terms like that. Now, I understand people can think this is a morbid conversation. You know, being raised in a family of all life insurance producers, we often would joke and try to bring some humor to the subject because I understand this is not a comfortable subject for any of us. But the truth of the matter is, if you go into the whole conversation understanding that we are all going to die one day, nothing we can do about it, it's just the way life works. If we understand that, and we understand whether I buy life insurance on you or not, has absolutely no impact on whether you live or die one day longer or one day shorter, then we're way ahead of the game. Understand, life insurance, the purchase of it, does not impact how long or short you live. So therefore, let's move away from this idea of morbidity, and we don't like discussing our own mortality. Of course we don't like it. But if you are in a position where you've worked your entire lifetime to amass whatever it is, you have monies invested that throw off income in order for you to maintain your lifestyle, and on top of that you have extra monies that you don't need to invest, but you do. If I ask why, many people say, oh, well, it's because we want to leave more to our family, or some of us have the ideology that he or she who dies with the most wins, or it's just a game. I just want to accumulate. I want to do the responsible thing because I do not want to take all this extra money that I have that I don't need to maintain my lifestyle and stuff it under the mattress, because that's not a responsible way to handle money. Then it all comes back to, as I said, leaving more for a legacy, for your family, for charity, for grandchildren, for great-grandchildren. And if that ultimately becomes one of the goals, then do we really care whether it came from stocks, bonds, real estate, life insurance, or chocolate chip cookies? It all spends the same. But what you will learn today is how life insurance can not only create the monies that you desire for your family, but can also help eliminate a tremendous amount of risk that other avenues have within them in order for you to get to the same result that we will share with you through life insurance today. Stay tuned. It's going to be a wild ride of fun and excitement. I know you've never heard someone say that when it comes to life insurance, but I will tell you this. Being raised by my father, Barry Kaye, at the age of 3 or 4 years old, as early as I can remember, sitting at that dinner table, and he would come home and talk to us about what he was able to accomplish with people with life insurance, with such excitement, with such passion. This man could convince you that life insurance was the cure for the common cold. That's how passionate he was. And he wasn't going to let anyone tell him that life insurance wasn't needed or wanted in anyone's family, because he's going to show you why it fits. And that's what we're going to share with you today. We'll be back in a moment.